Hello again, everybody. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, June 30th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about current financial market conditions. That is when to be on offense and looking for opportunities in the market, and when to be playing defense and protecting your capital. Asbury Research has been providing both investment research services and money management to individual and professional investors since 2005. For more information about us, visit asburyresearch.com and use the contact tab, or just click the link on the description of this video. Finally, if these YouTube videos are useful to you and you'd like to see more of them, please like and subscribe. Let's begin with just a couple of brief announcements. This past Wednesday, June the 26th, I was a featured guest on the Investors Business Daily podcast called Investing with IBD. This 53-minute interview, entitled How to Make More Money by Handling Faster Market Rotations, details Asbury Research's data-driven approach to investing. You could view that interview via the media page at asburyresearch.com or just via Asbury Research's YouTube channel. Here is the media tab right there on asburyresearch.com. In addition, on June the 9th, a few weeks ago, I was a featured industry expert on stockcharts.com. This 16-minute video is also available on Asbury Research's media page or on Asbury Research's YouTube channel. Tomorrow, July 1st, I will be a guest on Stock Market TV's morning show with JC Peretz from 9 o'clock to 10 o'clock in the morning Eastern time. That's from 8 to 9 Chicago time, which is where I am. Now let's follow the money by identifying the key areas of our focus over the next several weeks. Asbury Research's latest market themes. Next week's economic calendar. The June FOMC minutes are going to be released on Wednesday afternoon, which is going to be July 3rd. We then have the holiday, the NYSE holiday on the 4th. And then we have on Friday, the June jobs report. The median forecast for that is 195,000 jobs. There was plus 272,000 back in May, which was a surprise to the market. It bears a little extra mentioning that there may be some thin trading next week around the 4th of July holiday. It's in the middle of the week. There's going to be a lot of people that are going to be wrapping that around a holiday for themselves and their families, which, if there's any surprises, either in the language in the FOMC or in the jobs report on Friday, it could add to volatility. So just be aware of that. The next thing that I want to look at is the S&P 500 chart. So we're going to change our view here. And here's the S&P 500 daily. This goes back to October of last year. And we've got the 200 and the 50-day moving averages in orange here and in blue, which are the major and minor trend proxies as far as we're concerned. Primary tactical support right now is 3% below the market at 53.05 to 52.70. You see, we've got a little minor support here at 53.42, but the area that we're the most interested in is 53.05 to 52.70. That's the uptrend line from October of last year, and that's the 50-day moving average. If we break through there, that would indicate that the minor uptrend is no longer valid, and it would open the doors for a deeper decline. Major strategic support is 12% below the market at 48.66 to 48.19. That's a 200-day moving average here in orange, and 48.19 is a January 22 benchmark high. That's 12% below the market. So theoretically, if we do have a breakdown here and we get down through support at 53.05 to 52.70, the market could drop by another 9% and still be in a major uptrend. So just some areas to watch and some things to think about as we go into what might be kind of a choppy week next week with two important pieces of data and potentially thin market. Next, let's move over to market internals. and we're going to look at our Asbury 6. We're going to go into the Research Center. It's password protected for our subscribers. And we're going to scroll down and go right here to the Asbury 6. And you can see 5 of the Asbury 6 are currently positive. The Asbury 6 are the rate of change in the S&P 500, the relative performance of stocks versus high yield bonds, investor asset flows, volatility, trading volume, and market breadth. 5 of the 6, as you can see, are currently positive. 4 or more of them being green or positive indicates favorable market internals for the broad market to move higher on a tactical basis. This is a tactical tool. It isn't looking forward into the election or looking forward to the end of the summer. This is telling you what the market internals are right now. We built this because it's become increasingly difficult to tell what's going on within the market by looking at the S&P, staring at the S&P 500 all day. We have lots of volatility every day, as we know. We could be 50 points higher at 10 o'clock in the morning and be 50 lower by lunchtime. So this was our way of looking at 6 diverse internal metrics that measure the internal strength of the market. We back tested these together as kind of a team to give us a clear indication of what the health of the market is. How many of the 6 cylinders in the market, if you want to look at it that way, are actually healthy and driving the car forward. The next thing we want to talk about is our correction protection model, or our CPM, which is also available on the Research Center here. It's right next to the Asbury 6. Our CPM, with the exception of 2 weeks in April, has been risk on since November the 3rd of last year. The S&P 500 is up 28% since then. Unlike the Asbury 6, which is an indicator, our CPM, its job is to keep us in the market as much as possible because we know the stock market has an inherent upward bias. So it tries to keep us in the market as much as possible, but get us out of the way during periods where there's a significant correction lower, so we can ideally allocate our money underneath the market at better levels. Over the past 7 years, CPM has stuck like glue to the S&P 500 with about 40% less risk and less drawdown. So the S&P 500, I think over that period, had a 34% max drawdown. We're around 20% following the CPM. So for older, wealthier, and maybe more investors that aren't willing to take as much risk as they did when they were 30 and 40 years old, this is a way for them to participate in the market without really giving up anything, according to our back testing, but sleeping better at night with a lot lower drawdowns. You can see a lot more data, charts, and information about our models by going here to models, clicking that, and scrolling to the model you want, and just following the prompts. The next thing we're going to look at is sector rotation. So we're going to go here to our CEF model. Our CEF model, we built our CEF model probably the first version of this 6, 7, 8 years ago because sector rotation started to speed up. So we came up with a methodology that, rather than following the relative outperformance or underperformance, as we can see on the chart, we're actually following the velocity of money as it moves around these 11 sector spiders, which together are the S&P 500 in 3 different time frames. So technology and communication services, which are XLK and XLC, are the only 2 sectors that have outperformed the S&P 500 thus far this year by 3.4% and 3.1% respectively. And you could see they are the number two and the number 3 sectors according to our CEF model. The way our CEF model works is we are always equally invested in the top 3 sectors. The model is rebalanced weekly. Although sector rotation has been extremely choppy and frenetic this year as the market tries to figure out where we're going here with election coming up and a lot of different opinions on whether the Fed is going to start to lower interest rates or raise them. Our CEF model has been overweight tech, XLK, for 17 of the 27 weeks thus far this year, year to date since January, and has been overweight communication services XLC for 15 of those 27 weeks. Note on the bottom here, the three that are the weakest right now are energy, industrials, and the material sector. So if you were looking at this broadly, you would be looking to avoid these sectors that are the weakest on the bottom and looking to allocate towards the sectors where the money is going. Let's take a closer look at the CEF model via our rainbow charts. This is a rainbow chart. Let's make it a touch bigger. This is a rainbow chart for the technology sector, XLK. This looks 1 year back on the actual signals from the CEF model. So favored is green and neutral is yellow and red is a void. That's the name, the rainbow charts. Down here is the corresponding relative performance chart between XLK and SPY, the ETF for the S&P 500. So what we can see here is as of May the 15th, XLK moved into favored status according to our CEF model, and with the exception of just a little blip here in the beginning of June, has stayed there ever since. In the meantime, XLK has outperformed the S&P 500 or SPY by 5%. So this is how we kind of make the connection between what's going on in the CEF model and how it's affecting the relative performance of that sector. As the money goes into a sector, it tends to outperform. Of course, there are other factors that move these relative performance relationships around, but the asset flow, in my view, is probably the most influential of all these different influences that are there. Next couple things I want to look at are is Microsoft and Apple, which to me are our two keys for this particular episode of Follow the Money to what happens to the market from here. Let's start by taking a look at Microsoft, which is right here. Let's make it a touch bigger. Microsoft had a breakout on June the 11th. There was a lot of important financial information and news that came out pertaining to both Microsoft and Apple on or around June the 11th. So we broke out of this sideways period that we had been in since September of last year. This particular chart pattern going from investor indecision here back to resuming the trend that started in September of last year, it targets another 6% move higher to 473 right here. That will stay valid as long as we stay over, up and above this 431 area, which is the top of the investor indecision pattern. The next one is Apple. Let's make that one a touch bigger. Same basic story in Apple. We had a trend up since the beginning of the year, and then we drifted sideways. Actually, this was July. This was January of 23. We got up to July of 2023. We drifted sideways for almost a year, kind of going up and down through the 200-day moving average. We broke out on that same date on June the 11th. Out of investor indecision and back to the bigger pattern higher that began in January of last year. That targets another 9% move higher to 230, as long as we stay up above the top of the pattern here, which is about, let's call it 180. So above 180-ish, target another 9% higher to 230. Why does that matter? Apple and Microsoft are the two biggest stocks according to market cap. They have a lot of sway over all of the major indexes, and they have maintained a very tight and stable linear correlation to the S&P 500 through the past 35 to 40 years. So because of their huge market cap, because of the fact that just a handful of AI-related stocks, including these two, are really driving the bus for the market this year, our focus very much on these two stocks. As long as they hold these breakouts and these patterns that we made a couple of weeks ago, we can still see some strength here as we go through the summer. Finally, let's talk about non-U.S. equities. Let's go back here to where we were before. I'm not going to go into our U.S. versus the world model just for time's sake today, but Non-US equities as a whole relative to SPY have weakened significantly over the past 6 weeks, with Taiwan being the only country that's been outperforming SPX on a tactical and a strategic basis for us is monthly and quarterly. And that's just simply due to being responsible for about two-thirds of AI server production worldwide. So we see this lack of relative outperformance versus our country versus the S&P by the rest of the world as an indication of confidence moving back into the U.S. market after several of our major indexes here, including the S&P and both of the NASDAQs, have set new all-time highs over the past several weeks. So that wraps up another Asbury Research's Following the Money podcast for this week. Our next Following the Money podcast is tentatively scheduled for July 14th, which is 2 Sundays from today. If you would like further information about our research subscriptions and asset management services for both individual and professional investors, contact us today by going to asburyresearch.com, which is right here, clicking on the contact tab and giving us your information so we can reach back out to you. Hope to see you here again soon. Have a fun 4th of July next week, and don't forget to like and subscribe.